Welcome, everyone. I am Brian Christie. I am the co-chair of the Crowdfunding Professional Association. And today's webinar is going to be, it's a little bit of a tradition we've started here with CfPA, and that is to have the president give, the president-elect give their vision for the year ahead, their vision for the industry, and their vision for the association. And I am past president from 2024, so we started this little tradition back in 23. Jenny Casson, unfortunately, couldn't be here. She's the current president. She had a conflict, couldn't be here today. So in the co-chair role, I'm stepping in to do the introduction for Brian Belley. And so Brian is the vice president of the association. He will rotate into the president's position starting January 1, but I know that some of his responsibilities have already started to kick in. So it's my honor to introduce Brian. Brian has been a very active member of the association, a huge contributor. Really, I'm super happy to see that he's willing to step into this role. And I know that the association is going to accomplish a lot of great things, continue to accomplish a lot of great things under his stewardship. So let me give his official bio here, and then I'll turn the floor over to him to start speaking about his vision for the year ahead. So Brian Belley is an aerospace engineer turned tech entrepreneur with a keen eye for innovative financing in the startup ecosystem. He was the founder of Crowdwise and VentureWallet, which were acquired by Kingscrowd in 2021. So he's now the CTO at Kingscrowd. He's made 230 personal angel investments. That may be Reg CF, Reg A, Reg D, and he's really deeply entrenched in this regulated investment crowdfunding landscape. He gives a lot of advice to startups, to investors, and he really provides them with really invaluable insights when he does. He's also in the past worked and done assignments with Fortune 500 companies, and he's founded multiple ventures. So he really brings an interesting perspective, sort of all 360, all aspects of the crowdfunding space. He understands it quite well, and we're very excited to have him in the president's chair for the year ahead. So with that, Brian, I'll turn it over to you, and look forward to hearing what the vision will be for the year ahead.
Thanks for that introduction, Brian, and just want to echo what Brian said, but also thank Brian and past presidents. Really, a lot of where the organization and where the industry is today is because of a lot of the foundations that they've laid. So I'll be talking about this as part of our board succession and how we have kind of the rotations for our executive officers. But Brian and then Jenny, who's the outgoing president this year, have just, and past presidents have contributed so much to really set us up for success and be able to continue building it where we're at. So thank you to you, Brian. And I just want to give a shout out to Jenny as well, who couldn't be here, but Jenny last year just did so much for the organization, continued to really elevate us in the industry, added huge value in terms of the policy committee and everything else. So I have some very big shoes to fill there. I will share my screen and get into the presentation. So what I'm going to be talking about today, this is a tradition we started a couple of years ago now, is the president-elect's vision for the industry and the association. Now, the 2016 theme, I've kind of come on, I was thinking about, what is our theme going to be? What am I personally, in terms of reflecting of where the industry and where the organization is? I think it's a pretty big year coming up. We're coming up on 10 years of regulation crowdfunding with 2026, and the theme is going to be from access to outcomes. I'll be getting into exactly what that means, but basically talking about building a sustainable investment crowdfunding flywheel that works for all of the industry stakeholders. Now, I'm going to be giving a brief overview of the organization. So for those of you who may be attending today who aren't as familiar with the CfPA, we will go into a little bit of that, and then I'll be talking about the vision moving forward. So Crowdfunding Professional Association, this is a picture from this year's Regulated Investment Crowdfunding Summit in Washington, D.C. in October. So this is an annual summit. The second year we've had this. We had great turnout. It was bigger than the year before, and we know that next year is going to be bigger again. So if you haven't already, pencil in, we don't have the exact date yet, but probably that roughly third week of October, we'll be hosting another summit in person. This really brings everyone together, but a lot of the board members are pictured here. A lot of the industry professionals, platform owners, you can see SEC Commissioner Peirce in the middle there. So we've had a really great turnout, just lots of fantastic conversations that happen there. Now, as an organization, our mission, as has been reiterated in the past, is basically around regulated investment crowdfunding. So we're supporting that economy and the whole industry by supporting the issuers, the investors, as well as working with different portal operators and other professionals who are in the space. We work to advance this industry through advocacy, education, and advancing. Now, when we talk about the CFPA in terms of the structure, we are set up as a 501c6 trade association. That means we do have a little bit of the flexibility there to be able to do lobbying and different things in DC. But we really focus again on that education, the advocacy, and advancing. Very important call out is we are an all volunteer board. So the entire board of directors, and we have our fantastic community coordinator, Rose, who is helping to run this call today. So shout out to Rose, but everything is all volunteer. So everything that we do is such a testament to the board members, to the directors, to the committee participants, to all of you who are already members of the Crowdfunding Professional Association, just to be able to pull off everything that we have so far in such a short amount of time. Now we host the annual summit that I alluded to in Washington, D.C. We also do monthly educational webinars, but a lot of the operations of kind of what goes on really happens through our committee structure. So we have 4 operational committees, including a new one I'm going to be talking about today, which is the intermediary committee. But we have the policy committee, which really is focused with 2 subcommittees on the legislative and the SEC side. We have our growth and marketing committee, which is headed up to look at membership growth and just getting the word out there. How do we continue to elevate the message of regulated investment crowdfunding for all participants? And our education events committee. So part of that is planning the annual summit, but also other events that we have going on. And we've expanded that to include education this year. Now, important thing about the board of the CFPA as well is we are very diverse in terms of the stakeholder representation. So I like to think that we have all of the different types of stakeholders on the board to represent the different types of stakeholders in the industry that we represent, whether that's founders, investors, funding platforms, attorneys, accountants, anyone from real estate to high growth startups, everything in between. So really diverse board, fantastic group of people. If you're interested in learning more or joining as a member, we put the QR code there. Head over to cfpa.org/join, only $10 a month. But with that, that's kind of about the CFPA. And we'll be talking about some of the great accomplishments we've had throughout the past year, as well as what that's going to look like moving forward. Now, just one other point to mention is we have an interesting kind of executive committee rotation structure that was introduced a couple years ago that has been working fantastic so far. So, this really goes back to, I'll shout out Scott McIntyre, who really kept the organization together in the early days and getting things started. Devin then came in to be the original president back in 2023, set up the organization great just in terms of getting our org structure back in place with bylaws. Brian elevated us really to be recentering us around that education, the advancing, the advocacy, as well as setting up that first annual summit in DC, which has been huge for us and for the industry. And Jenny continued with great progress last year. So the way the rotation works is basically going from president. The president will rotate into the chair role when they move out, and then the person who is vice president moves into that incoming president role. So that's why I'm taking over for Jenny this year. Next year, Jason Fishman will be after me. He'll be coming in as the president. And then Andrew Stevenson, who serves as the current secretary, 2 years down. So it's a great rotational structure. This allows for just really diversity of thought and really keeping things interesting and engaging for us as an organization, and being able to make sure that we're always having fresh ideas coming in and having someone who's coming in that's passionate, that's energized, because it's a lot of work. Again, as an all volunteer organization, everything that we do is due to the board members that we have. Now, real quick about me, and then I won't talk anymore about myself. As Brian already mentioned, I'm CTO at Kingscrowd. I have made a lot of, I quote, private market investments. I say, in quotes, private market, because Reg CF, Reg A being the bulk of those, these are available to everyone, right? So when we talk about regulated investment crowdfunding, it's really not just Reg CF and Reg A, even there's, intrastate kind of Rule 504, potentially even, Reg D, 506C, but that's only accredited investors. So anything that is available to the typical person through these different online portals or different offering platforms is, what we call under that umbrella of regulated investment crowdfunding. Now, myself, I've always had a really big interest just in alternative finance and kind of private market exposure. So I've been dabbling in like crypto and peer-to-peer lending on, it used to be Lending Club or Prosper, those types of sites since 2013. Made my first Regulation A investment without even knowing what Reg A was at the time in 2014. Crowdsourced real estate in 2016, and then I really started building my diversified portfolio in Reg CF and really starting to invest a lot in 2017. So I also, keep up on some of the more passion projects, I call it, not necessarily, part of my core holdings of an investment portfolio, but when we're talking about collectibles, art, and NFTs, even collectibles and art, a lot of those being done under regulations like Reg A does kind of fall into our space. So it's all stuff that I've had a real passion and interest for, and definitely coming at it from that investor perspective. But in addition, working at Kingscrowd, we have now done a series of different basically regulation crowdfunding and regulation A raises ourselves. And so have a really good perspective from the founder side. And then through my role at Kingscrowd and seeing the data and overlooking the markets, we talk to a lot of the operators, the funding platforms, and so I have a really good overview of the industry as a whole. Now, this year, as I mentioned, is going to be a big year for regulation crowdfunding. So we're coming up on 10 years. So since the Jobs Act went into effect in May 2016, 2026 marks that 10-year anniversary. Where we've come since 2016 is more than $2.5 billion raised across more than 9,500 offerings under Reg CF and $2.1 billion raised across nearly 415 offerings in Reg A operating companies. The important call out there is there's actually many more hundreds of millions, if not billions, raised on some of these other fractional platforms as well. So when we're talking about real estate or collectibles or different things like that, this number is only looking at the operating company raises under Reg A. So Reg A has additional huge volume raised there. But when we're looking at the market, typically, this is from Kingscrowd data as of yesterday, so it's hot off the presses. But year to date, we are at, for total for regulated investment crowdfunding, 760 million. This is a huge increase, actually, compared to last year. So at this point, actually, in all total last year, there was $505 million raised. We're up 50%, probably going to end the year up more than 50%, obviously. And the breakdown between that, 313 million for regulation crowdfunding, which has been relatively stable. Regulation A saw a huge resurgence in 2025. So as you can see in this chart, it more than doubled nearly. It was up more than 100% for Regulation A. So a ton of the growth this year due to some big Regulation A raises and just the campaigns that we've seen there. But regulated investment crowdfunding is on track for the highest volume since 2021. So it's a very exciting time to be involved. And we're seeing a lot of investors who maybe in some of the tougher years in 2022, 2023 were pulling back. We're seeing some of those investors coming back into the market and activity is starting to tick up again. Now, for the theme of this year, right, in terms of talking about from access to outcomes, I want to frame it in a couple different ways. So first year, 10 years of Reg CF has really been about access. So when we think about this, Jobs Act first went live in May 2016. People didn't really know what to expect. We were still working through the legalization of crowdfunding, trying to figure out how do you build portals and regulatory frameworks? How do you interact with issuers? What are going to be the stumbling blocks and things don't people know? So a lot of it was around the finding out the logistics, figuring out the mechanics. The next decade, I think, it's going to start pivoting. This is not to say we are done with access. There's still a lot done on the infrastructure side, the plumbing side that needs to be fixed. But the next decade, I believe, really has to be about outcomes as well. So the framework I kind of think of it, we have the three I's. You have your investors, you have your issuers, and you have your intermediaries. Now, what does outcomes look like for investors? That means, are the investors getting fair experiences? Is there visibility and transparency, not just during the raise, but after the raise in terms of what's happening? And are they starting to get some real financial wins? Now, not every company is going to be a success. Small businesses are inherently risky. We know this. But we've seen that actually the failure rate from Kingscrowd data for the companies that have raised via regulation crowdfunding or regulation A, it's more on the order of 10%, 15%, where you compare that to something like venture capital or just early stage investing in general with angel investing tend to be 8 or 9 out of 10 companies fail. So you're talking an 80 to 90% failure rate. So very big difference that we're seeing there. And a lot of this could be attributed to that community capital coming in where people are able to engage with their investments, especially if they're investing locally in some of these businesses they're supporting. But in terms of outcomes, we'll be talking about that a little bit more in detail on the investor side. For issuers, outcomes, not just closing the rounds. A lot of our data to date has been focused on how much did a company raise, right? How many investors did you get? And that's kind of the outcome. We're looking at long-term sustainability of outcomes for issuers. So we're talking about building durable companies, whether that's a high-growth startup or a small business, right? And having fair exits and paybacks for their investors, but that also means that they're going to be contributing to job creation, to economic activity in the marketplaces that they're in. So very long-term sustainable is what we're looking for there for the issuers. And of course, underpinning both of those are the intermediaries. None of this happens in the industry without the intermediaries. Those are the funding portals, the broker-dealers that help to do these offerings online. And without them, if there's not sustainable economics in terms of how they're making their own business model work, the rest of this doesn't really work. So that's kind of the three pillars of basically thinking about starting to shift our mindset of not only about access, how much are they raising, but are we actually having sustainable access? And that's where kind of the outcomes for each of these three comes into play. Now, a framework for kind of just showing this as a flywheel, right? We have the intermediaries, the issuers, and the investors. None of these kind of three legs of the proverbial stool can kind of exist without the others, right? So without the intermediaries, they control the whole experience for the issuers, both from a compliance side, but also just in terms of the user interface and the experience, also for the investors. But without those issuers, if you don't have businesses that are high quality, that are interesting to investors, that are driving passionate from their communities, you're not going to attract the investors. And of course, without all the investors there, the issuers aren't going to be attracted. So it is this flywheel effect where the more that we can support the intermediaries in the long term, has better quality for the issuers, which attracts more issuers, higher quality issuers, which attracts more investors, and the whole flywheel goes around. So we'll be talking more about this when I get into the vision, but I want to rewind real quick and just revisit some of our progress and wins from 2025. So CFPA was very busy this year, again, under the leadership of Jenny, made a lot of huge strides, especially, Jenny was the chair of multiple committees, including the policy committee and working on the legislative subcommittee, but has really just gone a long way towards having the CFPA be recognized as an authority on the Hill and working with the Hill. So we've built and developed some amazing relationships through a lot of Jenny's and the board's efforts. And we're going to be talking about some of those progress and wins. Now, on the education front, webinars. So for those who aren't already aware, the CFPA does monthly educational webinars that span diverse topics. So these cover kind of all the different I's that I just talked about, whether you're an issuer, an investor, an intermediary, or just part of the infrastructure layer if you are a service provider. These have fantastic opportunities to be able to knowledge share and just see what's working and hear some really interesting topics. Some of the ones we did last year ranged from tax credits to industry updates, AI tools for issuers running campaigns, CDFI, partnerships, investor outcomes and failures, lessons learned. So just lots of really interesting topics from 2025. Now, moving into 2026, we're already lining up some of those first webinars. So we're going to be talking about a couple hot topics such as annual reporting compliance. This is a big thing that actually Commissioner Peirce brought up and that was brought up at our industry summit, but that comes up every year. It's that, roughly 30% of all issuers who are supposed to be filing these annual reports to the SEC are actually filing them. So there's a lot of misunderstanding, a lot of questions there. I think sometimes it looks like a scarier thing than it ends up being, but we're going to be doing a webinar to just kind of break that down in terms of what the annual reporting requirements are and how to do that for issuers. We're also going to be giving a state of the industry. So this is when we kind of look back at 2025 and say, hey, how did we do? And especially given where we're coming up on 10 years of Reg CF, I think we can look back even further and just kind of help to frame that for the regulators, for the legislators, for everyone who's involved to know where we're at. Now, another thing we're going to be doing as a webinar probably in Q1 of next year are new and emerging assets for investors. So if you're on some of these regulation crowdfunding platforms, you've realized by now that it's not just companies that are, software startups or CPG companies that are offering on these platforms. There are opportunities to invest in racehorses, back your latest films, to be able to invest in rev shares with creators. There's lots of different types of investment opportunities and assets that are out there. So we're going to be breaking down what some of those different and new opportunities are to be able to help you, who are all the investors out there, or if you're one of those issuers thinking about that, to be able to break that down. So if you haven't already, this alone is worth the $10 a month, membership for the Crowdfunding Professional Association. It's extremely affordable, but webinars, these get posted after the fact, but you definitely will hear about it first if you're on our membership list. So make sure you sign up and join in for each of these upcoming monthly webinars in the coming year. In addition to that, we had our second annual in-person investment crowdfunding summit this year. So we all descend on DC, had dozens of just some of the highest quality speakers. You can see Commissioner Hester Peirce there being highlighted as, one of the keynotes. But we have, again, portal operators, marketing agencies, issuers, investors, everyone in between that you can think of sharing just what's happening in their corner of the market. This is a fantastic networking, knowledge sharing opportunity, Everyone who attended this year just said it was even better than the last year, and we know this year is going to be better yet again. So for those of you who weren't able to attend in person, highly recommend you kind of pencil that in for this coming October in 2026. But we will hopefully be back in DC again to have our third annual. And to be clear, these existed prior to a while ago, but we really just kind of started up the in-person series again. So it's our third consecutive annual kind of since post-COVID. Now, in addition to that, since we are going to be in DC, one of the things that happens alongside that Regulated Investment Crowdfunding Summit is advocacy. And so we tend to spend actually the first day as kind of pre-summit meetings where we go and we meet with the SEC, we meet with regulators, we meet on the Hill to be able to share the CFPA policy positions. This is something that we've developed over the past few years that has 18 of our prioritized policy position points as approved by the board of directors at the CFPA. We actually had more items that went into it, but basically these are the 18 that the board agreed these are pretty critical and vital to our mission and what we're looking to do for the industry. And because of that, we've had great discussions, spanning through lots of different people at in DC, including, as you can see in the bottom left picture here, this is Brian Christie, who just introduced me today, with Megan from Dealmaker. We've been invited to some closed door meetings now. So we are starting to get recognition that, the CFPA is really an influential voice, that we really have kind of that boots on the ground knowledge of what's happening in our industry. That the SEC, as shown in the bottom right, we were invited to an SEC committee meeting, different meetings on the Hill. They're starting to reach out to us proactively. It's not us reaching out to them anymore. And so we're involved in a lot of these great conversations. So we've really been able to help continue to advocate for our industry and moving things forward and having a lot of our discussions. Another great reason to get involved. So all of our committee members do have to be CFPA members. But if you're interested in joining, for example, the policy committee, that's something that we extend to all of our members as an invitation, and you can then attend some of these meetings with us and be on the know in terms of what's going on. Now, on the advancing side, we actually have a bunch of different things, not just those legislative efforts where we're driving those policy changes, but different things like working groups. This is something that actually just came up at the last meeting we had, where we have some members who are very passionate about helping to establish data standards for debt investors. If you're a debt investor today and you try and go and get your returns, whether figuring it out for your own personal tax reasons or something else, it's very hard to get that from some of the platforms. It's in all different formats. And once you get more than just a couple investments, it becomes very hard to manage. Can we help to support and kind of sign off on these data standards to be able to help debt investors, or perhaps even for broader equity standards, that type of thing? So we're establishing working groups on an ad hoc basis that helps to kind of champion and move forward with some of these different initiatives. One of these initiatives that we also did pick up last year were tax credits. So we were basically proposing a Reg CF tax credit for everyone who invested in a Reg CF deal on their personal taxes. Now, benefits other than just incentivizing individual investors to be able to invest is the knowledge and awareness that that type of thing would bring, right? Every CPA out there who does taxes is now going to see this line on the form, which would help to kind of elevate the industry and increase awareness. Now, that's still a work in progress. Obviously, there's been a lot of changes in terms of the different administrations and being able to, with certain tight timelines, but that's something that is continuing to work today. So we have a bunch of these different little projects that are also kind of continuing and ongoing throughout the organization that people are welcome to get involved with as members. Now, let's go back to the vision for the industry. I want to start first with just something that I hear often, where I think people tend to look at regulated investment crowdfunding with a very broad brush and a very actually more of a narrow focus. So I'll say this. A lot of venture capitalists, right, are going to take a look at the industry, or if you're an angel investor, and they'll say Reg CF doesn't work, investment crowdfunding doesn't work. It's all small businesses, Main Street businesses that aren't VC backable, aren't VC growth profile. Okay. Now, a lot of the people who originally supported Reg CF in the early days, right, it was about supporting those Main Street and small businesses. They look at, part of what the industry has become today with a lot of high growth startups, and they say Reg CF doesn't work because, it's very expensive for small, mid-sized businesses, especially those, on Main Street, to be able to raise capital. So it's very important to understand that Reg CF is not just one or the other, and trying to lump everything under one metric and say it's a failure because does not work, because it serves the whole spectrum. So whether it's Main Street small businesses, CPG companies, innovative growth companies, all the way up to that high growth startup, Reg CF and Reg A can encompass all of those. So I think it's just really important to frame And keep in mind that when we're thinking about this, we're talking about both those spectrums, both companies that are raising up to 5 million of the max under Reg CF or 75 million under Reg A, also the ones that just need $50,000 or $100,000 to be able to make that new investment, in their Main Street business to be able to help serve their patrons a little bit better. So when we're thinking about this as a board, we have really interesting discussions at the CFPA at the board level because we do have all these constituents on our board and we have people from all these differing perspectives, but it's something really important to keep in mind just to frame it up like that. Now, going back to the flywheel and this framework for thinking about, we have the issuers, the investors, the intermediaries, right? Supporting each one of these is crucial for its own reason, in addition to supporting the others. And I think a lot of the focus to date, right, has been on the issuers. We've been trying to figure out how can we support more diverse small businesses, which is still super important. How much capital are they raising, right? A lot of the numbers are like, how many campaigns have we done? How much capital investment volume has there been? That sort of thing. As we start shifting and getting into the second decade of Reg CF, it's going to be just as important to make sure that we're having sustainable resilience and economics for those intermediaries. Are the platform business models, the intermediary business models actually working for them so that they can stick around? And then think of the strength and health of them being able to support better issuers, as well as for investors. Eventually, a lot of investors are going to be looking for outcomes and returns. Now, this does not mean that every single company they invest in needs to be a success, but were they treated fairly, transparently, honestly throughout the process, where they want to come back and be a repeat investor? So I'm going to break down kind of just each of these different, I call them the 3 I's. There is, of course, a 4th eye out there, which is the infrastructure layer, right? So when we think about things like transfer agents, escrow, cap table management, even just like what that process looks like of getting access to shares when a company goes public. These are all issues that we're now coming up against that maybe didn't have to worry about in years 1, 2, and 3 of Reg CF. But as we're maturing as an industry, we're in year 7 to 10 now. That's where the average kind of angel investment, early stage exit tends to come on the equity side. We need to start thinking about that, as well as on the debt side. As companies are having, maturity dates for some of the debt come due, and as they're making their payments, we're starting to see, some of these hurdles around how to treat taxes and that sort of thing. And so I think we need to start putting a focus on that as an industry to make sure that we're actually thinking about the long-term sustainability as a whole. So first, in terms of investors, I want to clarify one thing because I think when we say outcomes for investors, I think a lot of people's minds goes to, unicorn exit. It's very important, from my perspective, that when I say outcomes, I'm not just talking about unicorn exits. Strong outcomes could be that you got your share paid back, right, for a rev share or for a debt deal. It could be, a modest returns in M&A. Maybe you got some of the perks. Maybe that was your main reason for investing as an investor, was some of the perks that are offered through these. And in addition, as I mentioned, not every single investment is going to be a success. It is inherently risky. There's small companies that are going to shut down. Was it orderly? Was it transparent? Was the process at least communicated to investors with clear communications? Because in the end, I've seen campaigns go 2 ways. You invest in a company, it closes, you don't hear about it for 3 years, and the next communication you get is, hey, we're shutting down. Investors are not happy in that situation, right? I've seen the other way where, a company you invest 2 or 3 years later, but quarterly or semi-annually are getting an update. Hey, maybe sometimes things are great. Maybe they're saying and sharing some of their challenges. I have many of my investments that are very transparent actually and sharing a lot of their challenges. Honestly, even if the outcome is bad in a lot of those situations, investors feel more connected. They feel like they were treated fairly. And a lot of times they're like, hey, you gave it your best. You know what? Next time you start a company, let me know. I'd like to invest again. So I think handling the process, whether or not the outcome is good, is going to help this repeat investor rate. And if we just think of kind of the top of funnel of all the investors, in the United States who might be potential investors in regulation crowdfunding, we don't want them to go through the funnel, have a bad experience once and never come back, because that's kind of our one shot at getting them. If we can ensure that, there's good stewardship throughout the way by the issuers, that they're having good experiences on the platforms and that they want to come back and be repeat investors, that's how we're going to drive the volume of this market to be able to continue to grow, which then attracts more issuers, which makes it more sustainable for the intermediaries. And so I think investors and just handling them in a way that's fair is going to be crucial to the success of the industry. Now, what does that look like? So on the returns realization side, right? Yes, eventually they're going to want financial returns, redemptions, potential secondary liquidity. But as I mentioned, with that experience, it's just, do we have clear disclosures? Is it clear that they're getting understandable terms up front, that they understand what they're investing in, reasonable fees? Do they even understand there's going to be potential tax outcomes or consequences for their investment? Just having fewer gotchas along the way. And I think some of the ways that the Crowdfunding Professional Association can help with that through the education and the different things, but potentially things like standards and being able to introduce different ways to be able to help either the platforms and or the issuers have more of that expectation setting up front and have a more consistent experience for investors, whether you're investing on one platform or another. And all of that goes to build trust, right? So when I talk about trust, it's not just trust that, hey, you're investing in something that they did their bad actor checks and it's not fraud, but trust in terms of are they getting predictable communications from their investments? It includes bad news. And as I mentioned, I shared that story. Sometimes, even if you share that bad news, it's just better for investors a lot of the times to hear that and they will sympathize with you versus if they don't hear anything for years and then that's the last they hear. And then visible accountability, right? So again, all of this, I think, going back to the key point for investors of why outcomes are so important, it's repeat participation. If we want to help to build this sustainable flywheel, we can't have a bunch of investors who are just going to be one-time investors. And whether they come back to make that repeat investment really depends on that experience that they had. Now, in addition to this, there's another part of the investor part of this equation, which are the registered investment advisors, the RIAs, and institutional capital. So there's the potential as well for professionalization of if we can show good experiences, good and high quality, investment opportunities, it will attract potentially more RIAs and institutional players to come in. And we've talked about things in the past, such as, matching fund concepts, whether it's at the state level or with foundations, that type of thing. But I think even having crowd literate kind of registered investment advisor training, micro certifications that we as the CFPA could be able to help, or even just public directories. So one of the things I'll be sharing at the end as well is the crowdfunding ecosystem. There's a great resource that's available to all CFPA members, but through that, you can create your own public listing page or microsites on that. And if you're a registered investment advisor, a platform, or anyone else, it's a great way to get your name out there. So I think there's still lots of opportunity. This is definitely an untapped part of the whole equation because if we can get more of these registered investment advisors in and interested, they are going to bring a lot of their investment clients with them that will then find out about this opportunity. So lots of opportunity there. But let's move on to the second I, which is the issuers. Now, when I talk about issuer outcomes, really what we're kind of shifting the focus from, this is not to say again that we have nothing more to be done in terms of the plumbing and the infrastructure, but it is not just that, hey, we raise the round and that's the outcome. Trying to think more sustainable, long-term focused. The issuer outcomes is really, are they getting capital that works? Building company durability and doing it with responsible stewardship. So breaking down kind of each of those three pillars, right? Capital that works means deal terms that work for the company, but also right for the investor. And that means kind of alignment around making sure it's the right instrument for the business model. So if you're that high growth startup, you're probably going to have a different type of security instrument than the small or mid-sized business that's raising, for their brick and mortar company. So making sure we're having more alignment there. And again, that comes down to a little bit around the education side and what we can do as an organization and an industry to help make that more apparent so that each of the platforms doesn't always have to do this one-off education, but can we help make that more broad? Then the second thing is are they actually building company durability here, right? So we're talking about things like survival, growth rate. Yes, we want to see them growing and make sure they're profitable, sustainable, and not just that hey, we closed the round, now we're done. Realizing it's this more longer term journey where they are going to be raising potentially multiple rounds. You might be issuing multiple rounds of debt or multiple rounds of equity. And to be able to do that goes to the third point here around responsible stewardship. So I talk about stewardship here, right? Really what it means is, have they earned the right to raise capital again? So it was not just a transactional, we're going to extract money for this one round that we're doing to do this thing and then forget about those investors. A responsible steward of their investors and the capital is going to have, very transparent kind of operations, treat those investors like actual investors, not like a public company, right? We understand these companies are not public and a lot of them are making very small dollar check investments, but there are ways to manage those large groups of investments nowadays that's not that much of a burden for the companies. And in doing that, you will earn the right of those people. You will earn their respect to want to reinvest in your future rounds. So really it's things like predictable updates, clear governance, fair treatment of the crowd in future rounds. Do they want to come back? That's kind of one success metric that I use of whether a company is being a good steward of their initial investors. Now, what does this look like? To go from kind of this raise ready mindset to stewardship ready. The important thing, right, is just to realize that it doesn't happen at close. It's not the close of the funding round for the issuer is not the end. It's really the start of the relationship with those investors. So setting expectations up front, things around like fees, third-party costs, vehicle SPV implications, responsibilities. Yes, part of this comes to, are the investors reading the subscription docs? Do they understand what they're investing in? But a lot of it comes from communication of those issuers as well. So how can we also help to upgrade issuer literacy around these different things on deal terms and structure and that type of thing? So if they're doing an equity round, is their pricing, their valuation realistic? Do they understand dilution mechanics? Do they know when to offer a safe versus a convertible note versus preferred versus common, or different types of stock versus debt? All these types of things. Unfortunately, fortunately or unfortunately, at Kingscrowd, we overlook the thousands of raises, right? So we see all the different companies that are raising capital each year. We often run into many issuers that we will highlight things in their deal terms that are risks that they did not know were there as risks. So, part of this, I think, could be an education side. I think part of it needs to come from the responsibility of the industry, but also the intermediary and the issuers. We need them to realize that this is not just a transaction where you're coming in to get money and moving on. Like these are people who are going to be coming onto your cap table if they're investing in equity, and you're going to be treating them like investors. And so to have that respect for them, and how can we as an organization or an industry to help with that? We can think about things like standard templates where possible. Also making sure these templates are kind of tailored so they're specific to the crowd, not just taking whatever the latest, safe template is off Y Combinator and assuming that's going to work for the crowd investments, because a lot of times they're going to be structured different. They're going to have different dynamics, different kind of capital raising round dynamics. And we want to make sure that these deal terms and structures are going to work for the investors and for the issuers that are raising capital in the way that they are. Third, I think a lot actually of the opportunity could be in some of these post-raise playbooks. So at this point, as we're seeing more exits in the industry, more acquisitions, companies shut down, companies have gone through it. You're not going to be the first company as an issuer who's having an IPO, who's getting acquired, who is having something happen. How can we elevate that and share those stories and best practices, potentially put together playbooks so that a lot of this knowledge sharing can happen? This helps because it will help some of those issuers who then, go through these events to not make some of those same mistakes that have already been made, but also just with communication, right? So one of the things that happens a lot, and I've seen this through various of my companies that had IPOs, there's certain restrictions. When you do an IPO, you go through kind of the quiet period where you can't communicate, but there's other things that can sort of be done to either make that go well or not go well. And I've seen great examples of both. So how can we share these examples with the broader industry to make sure that for the issuers, it's a better experience and for the investors? Now, third are the intermediaries. So in terms of intermediary outcomes, we're kind of talking about sustainable business, right? So we need the economics to be able to work. Regulatory confidence, I'll talk about kind of consistency and regulatory oversight, and better market quality. And when I'm talking about market quality here, it does not mean, hey, do we have high revenue companies that are going to be public someday? But again, do we have the right types of companies with the right deal structures for the type of company that they are? As we showed with that whole spectrum of regulation crowdfunding companies, right? We have the small Main Street businesses. I've seen a lot of really successful companies like that with successful revenue share paybacks or debt notes. A lot of the film companies I've seen, with some of these rev share deals have fantastic returns for their investors, but it's not the typical VC quote investment that a VC or an angel might expect to see. So going through real quick each one of these, sustainable economics, we've already talked about this, but do they have unit economics that make sense for the business of that intermediary? And when I say intermediary, again, there's a little bit of industry jargon here, but we're talking about funding portals, broker dealers, the ones who are doing these offerings for the company. They're sort of that intermediary, the middle person that helps to host that raise for the issuer, which is the company, and then allows the investors to come to process their transactions. Now, this is very important with sustainable economics because they're responsible for a lot. They have to be compliant. They are regulated. Usually FINRA is overseeing them. They have exams and different compliance checks to go through. There's a lot of costs with operating a portal, and it can be very hard in terms of making the business model work for that. So we as an industry need to continue to see what can be done to create more sustainable economics, because if we can elevate all of these platforms in terms of their economics and just being able to deal with what is required by the law and the regulators, they can provide better experiences to the investors and to the issuers. They're the first touch point, right? Everyone who is going to either raise capital or make an investment is going to go through these intermediaries. And so the more that we can help to support and elevate them, the more that that will help to provide better experiences for the others. Now, on the regulatory confidence side, we've had a lot of discussions as an organization, but there's a lot of gray zones. Sometimes the regulators have different interpretations of the rules. And so we've seen through overlooking the whole industry that sometimes certain portals are told different things than other ones based on what's okay or not okay to do. So we're really going to be focusing on what can we do to help to push to get consistent oversight for these so that those firms, A, don't have to be changing based on the different person that they're talking to at the different agency, but they can also make longer term investments. Just provide more predictability, fewer gray zones so that they'll be able to operate with more confidence. Then in that market quality side, as I mentioned, there's some of it that goes into around like the issuer screening and support, but the investor user experience or post-close operations for those platforms that are able and choose to do that, right? Being able to provide updates, different corporate actions, transfers, all those types of things come into both the investor and the issuer experience, and making sure that we're providing a good experience to them ensures we're going to get repeat customers, so to speak, for those different parties. So what does this require? How do we get better outcomes for the intermediaries? As we already talked about, the regulatory consistency and predictability, full lifecycle support, right? If you think about just these companies for the intermediaries, they are doing kind of the before, the during, and the after. So making sure that we're thinking, how can we support them, whether it's with different standards or different things for pre-raise, active campaign, post-raise, closing, sustainable unit economics, and then trusted market standards. So, can we come up with benchmarks, best practices, and share across different intermediaries to be able to help build a better ecosystem for all of them? Now, I'll be going into how CFPA can support some of these, but just as a mindset shift, and not even a shift, really. It's adding on to what we've already been doing. So when we talk about the metrics that we're using to measure our industry and our growth and how we're being successful, a lot of the things we look at today, right, are dollars raised, number of campaigns, number of portals. These are things we've all seen, as Kingscrowd, we publish a lot of numbers on these. That's really a lot of these inputs to this, where we're looking at kind of that access and the growth, which is a really important part of laying that foundation. But again, moving forward, when we start thinking about the 3 I's, I think to get more outcome focused, we're going to have to start looking at some new metrics. Things like repeat investor participation, issuer survival and follow-on funding, exit liquidity events and paybacks, stewardship indicators. So not just like, are they doing their annual reporting, which is required under Regulation CF each year, but are they giving more frequent updates? And are investors having a good experience and coming back and making other investments, as well as portal intermediary sustainability? So I think, where we've come as an industry in the first 10 years has been fantastic. There's been a lot of hurdles. There still is a lot to overcome and a lot of improvements that can be made, but dollars raised and kind of measuring ourselves that way is just the start. Where we move in the future, as we start looking at some of these other metrics, will be kind of more outcome focused. And I really think personally, not speaking on behalf of CFPA, but for myself, I think that's where the long-term scorecard lies. So how do we help to strengthen this? So strengthening the CFPA and contributing to this under that 2026 theme of moving from access to outcomes. First, I think the board is a fantastic place just to mention as a reflection of the 3 I's. So we already talked about the stakeholder diversity. We have investors, retail, angel, RIAs. On the issuer side, we have founders, both on the Main Street and VC side. So we have a great kind of representation there, as well as marketing agencies, consultants. And on the intermediary side, we actually have numerous intermediary reps, not only on the board, but also as part of our different committees, whether that's broker-dealers, part of transfer agents, different infrastructure, plus a lot of cross-cutting roles. So we have lots of legal compliance, attorneys that sit on the board, accounting, data, and ecosystem partners. So through all of this, as a board, we in 2026 will definitely continue to work on our policy work, a lot of the great foundations that have already been laid, as well as continuing the in-person summits and continuing to have amazing discussions there, and continuing to engage with the regulators and legislators. So as I mentioned, we are being contacted more by these people to provide input rather than us having to actively reach out. So I will say in 2026, and soon we'll be actually doing a press release. We're going to be welcoming 6 new directors, and they actually span the gambit of the different stakeholders. So we have portal owner, accountant, academic, legal, consultants, all different people that are going to be joining the board, really keeping us a diverse representation of our industry and the stakeholders as a whole. So that's kind of one place where everything starts, right? Because being an all-volunteer board, everything flows down from there. But one of the other things we've started just recently in the past month or so is a new crowdfunding intermediary committee. If you are a potential or current broker dealer, funding platform, someone who's thinking about it, someone who works with them and want to be a part of this committee, reach out and let us know, because I think this is going to be really important to that third pillar of what we were talking about around intermediaries. Without these sustainable kind of portals, intermediaries, right, it just makes it hard for everything else to be successful for the issuers, for the investors. So potential goals for that committee, and the committee is going to be defining some of this and have really just started meeting. But thinking about like, can we map the economics of like small, medium, and large raises? Can we all agree on, or at least kind of identify, what are the top 5 regulatory challenges or pain points that we are having that we need to move, bring to these discussions with the SEC and FINRA? Potentially, can we even publish a 2026, state of the intermediary snapshot in terms of just what's working, what isn't working, fee structures, different things to be able to help everyone in the industry, make more data-driven, better decisions. So all of this is going to be providing input to the CFPA board, to our policy priorities, and definitely working with our SEC FINRA engagement. But again, for anyone who's interested in that committee, please reach out to us. Had kind of a first just kickoff planning call, but that's going to be continuing forward in 2026 and looking for a lot of good things out of that. In addition, on the education side, we're going to be continuing our monthly webinars. So as I already alluded to and kind of teased, we have our first 3 webinars planned for the current year, but really thinking about those in terms of that 3 I's framework again, right? We have investor-focused webinars, issuer-focused webinars, and intermediaries, making sure we're providing content that is helpful to each of those constituents. For example, we did a whole bunch of different investor-related webinars in 2025, a bunch from the issuer side, had a few on the intermediary side as well. So we're going to continue to think about the framing of this to make sure that the education, these webinars are bringing in some of the high-quality current conversations that are happening in the industry today to help each of these different stakeholders. And then on the data and standards front, so a little bit biased coming from Kingscrowd. We do so much with overlooking the industry and data as a whole, but thinking about ideas of, putting together as an organization, can we support a state of regulated investment crowdfunding report? Not just Kingscrowd, but collaborating with all the different partners who do data for our industry, for the platforms themselves. And potentially, as some of the outcomes from the intermediary committee, having some of these potential reports coming out just to be able to provide more information, because I think a lot of the times we who are internal to the industry might have a good idea or hear about and talk about things that are going on. But I think we need to work on our communication externally, right? So how are we communicating this to the SEC, to the regulators, to the rule makers and legislators to make sure that they actually have information that, we're not just also talking industry jargon to them, but they understand why it matters to them. So there's a lot of opportunity here, but being able to think about, different data standards and different things in terms of the outcome infrastructure also, so we can start measuring ourselves in our industry on some of these things that are going to be important moving forward. So I'm coming up on the last slides here. Before I leave, I want to make sure everyone who's watching this knows how they can get involved. If you're not already, make sure you can join us, cfpa.org/join. As I mentioned, it's only $10 a month for an individual membership. We also have corporate memberships, which give, I believe, 10 seats. But being a member comes with lots of different promotion discounts in terms of event discounts, especially for our investment crowdfunding summit. It pays for itself, basically, as long as you're a member. You'll get early access to the webinars. So $10 a month should be pretty much a no-brainer for everyone here who is interested in staying up to date on the latest. That's also required for committee participation. So if you want to be a part of the SEC committee or the events committee or anything else and kind of just be able to have some of those conversations with the people who are talking to the SEC and everything, join. It's a great membership. You get lots of value for that. In addition, as part of that, we have the crowdfunding ecosystem. This is something that helps us to be able to connect where you can go and see all the events, like the different webinars that are coming up each month, as well as look at microsites, connect with different vendors. So there's a vendor directory on there where you can see different people, whether you're looking for an attorney or a marketing person or someone else in your industry, you'll be able to find them on the vendor directory there. And if you are a company interested in sponsoring the CFPA, we definitely want to invite you to please reach out to us and have the conversation. We have some amazing sponsors that have supported us to date, that are sponsors at our investment crowdfunding summit and some of the different webinars that we do. And so you can check out at cfpa.org and go to the sponsors dropdown to be able to get information about the sponsorship packages. But it helps you get recognized, get your name out there in terms of people who are really involved in the industry. With that, I will end. This was a great photo from 2 years ago, the Regulated Investment Crowdfunding Summit. You can see we're in DC, like just an amazing view from this. But I will end it there with 10 minutes left and open it up to questions. So, Brian, I'll turn it back over to you. Thank you, everyone.
Y- Yes, thank you, Brian. This has been fantastic. You have a wealth of information, so appreciate you trying to share that in a short period of time because it's like drinking from a fire hose, they say expression. So there have been questions by people whether or not they can get the deck after this. So I think we'll make that available as well as this recording so that people can take it and put it on half speed when they watch it again, so they can start to digest a lot of that information you've shared. We did have a question that came up from the audience about really along the lines of concurrent raises. So I know we're not going to talk a lot about technical stuff here, but maybe there's one question, given your dual role at the CFPA as well as Kingscrowd, you have probably as good a view as anyone into are concurrent raises taking place where someone's raising a Reg CF campaign along with something, what are you seeing in that area, if anything?
Yeah, I will just make a disclaimer. I'm not on the legal side, and I know there's lots with concurrency raisings and regulations to make sure you're doing it properly. So reach out to your counsel, for all that. But we see, and we often refer to them as side by sides. We see a lot of side by side raises in the industry. Looking at the data from Kingscrowd, a lot of that, what it means is they will, for example, have a open regulation D raise, private offering, whether it's venture capital or angels, maybe they have an SPV or a syndicate, as well as a live and ongoing Reg CF raise. So yes, I think some of the advantages of that, from what we see, are that the crowd of investors, one of the things you need to do when you're raising on a Reg CF platform is kind of get some of that initial traction started, right? Because it's a bit of social proof to be able to show, hey, we've already raised $1 million for a few reasons. One, that de-risks it a little bit. If someone's at $5,000 raised and they haven't hit their minimum yet, it can be a little bit more of a hesitant choice or decision for an investor to say, do I want to commit money right now, or maybe I wait a little bit longer? So it can help to already have, more significant funds raised, which is why a lot of times too, I think we see a lot of these companies when they go live with their Reg CF offerings, they already have commitments from some insiders, even prior round investors, hey, 25K, 50K, if they can write that check and get you started, it really gets that flywheel started. In addition, I think you kind of alluded to this, Andrew, in your question. It's that yes, you get to co-invest alongside someone. And sometimes that company, if they're a venture capital firm, maybe already did some due diligence. And that can give the crowd a little bit more confidence of like, okay, someone has taken a look at this. They probably met face to face with the founder. They've kind of de-risked it from that perspective. So that can be a benefit there. And then the crowd, oftentimes, we see them opening up kind of their rounds to be able to allow their not their investors, their customers to invest, right? So you're not just going out because, hey, we raised from venture capital and now we just want to get some more investors in Reg CF, but like, hey, we want to allow our investors to invest in us. That's where we've seen it work really well. Usually those customers are your most engaged people. They already know you. So it's a lot easier of a decision for them to make that investment decision. And you're not just kind of reaching out and shouting into the void and trying to get complete strangers to figure out who you are, what your business is. So we've seen it work very well in that perspective as well.
So, thank you, Brian, for answering and addressing the technical. And I know that we'll have a lot of other opportunities throughout the year to do webinars. And some of them will be broad, big picture. Some can get very technical in some of these areas. So, perhaps a good topic for webinar may be this very topic and how those deals can structure. Can you speak maybe a little bit to some of the innovations taking place in the structuring of deals, even not from a legal perspective, but just a little bit about what we're seeing happening? Because a lot of people have a mindset that this has to be like a VC investment. You're waiting 10 years for an outcome, but a lot of things are allowing people to get liquidity right away. So could you maybe just speak to a little bit about the diversity of deal structures that are taking place?
Yeah, especially in recent years, we've seen several new funding platforms, the intermediaries themselves spin up that are focused on their own kind of unique deal structures. But as I was alluding to, and as Brian was mentioning, not every single company that is raising capital online has to be a quote venture backable company, right? With this really high growth trajectory where they're going to raise a couple $1 million and then they either make it or they don't. We see a lot of businesses that are trying to be a bit more even keeled, I'll call it, right? They're not trying to be this hyper growth company. They just maybe want some capital to be able to make that next marketing hire or something else, which will then help to accelerate their growth without going crazy. On the small business side, we are seeing some innovations in terms of just the types of structures that are being offered. Honestly, revenue share deals, I can't remember if they were around in the early days. I think even that was an innovation. It's been around for years now, but this ability where you're not just investing in a fixed income note where you're going to get, 10% a year on a debt note, but you will, for example, have a rev share agreement where it shares a percentage of the revenues. So what that does is it allows, as an issuer, maybe you have lots of customers in the summertime and it gets really quiet in the winter. It could be really hard to make consistent, 4 quarterly payments throughout those winter months if your revenue's dropping during that time. What these revenue share notes allow is basically the payments to shift based on the amount of revenue that you're making, and then could have a payback cap on that. So that's like a really kind of innovative way for something that's a little bit different that you might not see, or think about necessarily right away. But in addition, just different types of offerings. It's not just operating companies. As I mentioned, we there's racehorses that you can invest in. There's creators and YouTube channels. There's real estate deals. There's everything in between. So we're actually going to be offering a webinar probably in the first quarter again, whether it's the second month or something. In 2026, we're going to talk about some of these new different types of asset types that are emerging so that investors can get a better grasp on that. But we continue to see a lot of innovation there, even on the deal term side. I'll give a shout out, Silicon Prairie. They, came up with the SAFER, which is the safe plus like a revenue repayment kind of portion. So people are innovating and trying to think of like, how do we take what the standard, deal structure, deal term would be for someone like a VC, but then make it applicable for a different type of company or for a crowd of investors that maybe has a little bit of a different trajectory. So lots of innovation there, and we'll be sharing more on that this year for sure.
So, Brian, I want to yield back a little bit time to our audience, just a couple minutes, but this has been fantastic. Really, again, thank you on behalf of the other board members for stepping forward for this year, and we'll do whatever we can to help you realize your vision and move things forward for the year. So, encourage everyone to sign up to CFPA, as Brian mentioned, and again, super excited to see what's going to happen this year. Everyone who's listening, I think, encourage you to get involved at CFPA at various ways, and it's an exciting industry, lots of innovation taking place, and the years ahead are, I think, going to be much better than the years we've seen so far. So, with that, we'll close it out, and thank everyone for attending.
Thank you, everyone.
Okay.